NVIDIA dropped 1%. Its Moat scores 78 out of 100. High durability. At a price of $214.72. Routine market selling ignores the structural reality of full-stack lock-in. NVIDIA's defensibility rests on two primary engineering pillars spanning advanced silicon and proprietary networking fabrics. Our full teardown reveals exactly why these deep moats continue to protect enterprise compute dominance. What operating evidence matters most for NVIDIA Corporation? NVIDIA's Moat durability rests on two primary engineering pillars. And another question, what could weaken NVIDIA Corporation's Moat durability? The primary risk centers on physical packaging yields and custom silicon substitution. This matters because every portfolio model is pricing unconstrained demand and continuous margin expansion, but the engineering data shows different constraints. Shares closed at $214.72. Bloomberg reported fresh customer notifications of sweeping AI hardware price hikes. Capital is rotating across high-beta tech as portfolio managers brace for post-earnings volatility on the upcoming Wednesday. The Silicon reality reveals physical constraints Wall Street consistently overlooks. TSMC's CoWoS chip-on-wafer-on-substrate packaging with local silicon interconnects remains the primary production bottleneck for the Blackwell architecture. Each Blackwell computing die spans 800 square millimeters on TSMC's custom 4-nanometer process node. Packaging yields remain constrained when bonding high-bandwidth memory stacks, delivering 8 terabytes per second. Competing custom ASICs designed for dedicated workloads target lower thermal envelopes. These physical packaging bottlenecks prove pricing leverage is currently sustained by foundry allocation limits rather than software moats. The engineering data indicates physical assembly limits will dictate near-term revenue ceilings. Quarterly financials showing modest revenue momentum for NVIDIA. Rising borrowing costs are strangling enterprise capex, yet foundry demand is surging. The 10-year Treasury yield sits at 4.69%, raising hurdle rates for corporate capital expenditure. Capital is rotating out of the compute supply chain. Marvell dropped while HEICO held steady. Capex pressure is mounting. The Federal Reserve holds rates at a steady level with inflation at 0.6%. The yield spread sits at 0.50%. Macro conditions say enterprise expansion should freeze. Yet foundry revenue is accelerating. TSMC reported July sales of 467.6 billion new Taiwan dollars, surging strongly. Geopolitical pressure is everywhere, but NVIDIA's dominance absorbs it completely. Tightening export controls from the United States Commerce Department restrict shipments of compliance GPUs to Chinese hyperscalers. Cross-border trade disputes introduce complexity across multinational assembly corridors. Public scrutiny over grid energy consumption adds regulatory pressure on data center buildouts. Infrastructure financing is tightening, yet NVIDIA maintains overwhelming market dominance. Industry data from John Petty Research confirms discrete add-in board GPU share stands at 92%. NVIDIA generated 85.2% revenue growth and 214.5% earnings growth. Dominance beats friction. Beta, a stock's volatility relative to the market, is 2.21, amplifying macro shocks every quarterly earnings cycle, but market dominance shields growth. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. NVIDIA Compute is trending higher at $214.72. NVIDIA's insiders are selling, while the board doubles down on expansion. CEO Jensen Huang framed the narrative explicitly. The build-out of AI factories, the largest infrastructure expansion in human history, is accelerating at extraordinary speed. Jensen Huang, founder and CEO, Q1 FY27 press release. To cement this grand narrative, the board announced an additional $80.0 billion share repurchase authorization and raised quarterly cash dividends to 25 cents per share. But executive actions contradict the press release polish. Over the past 90 days, NVIDIA insiders net sold 1,901,125 shares. Management uses dividend increases to signal stability, but physical insiders are quietly reducing personal exposure at the peak of the hardware cycle. The headline numbers hold. Delivered an EPS beat. Earnings per share came in higher than estimated, marking 4 consecutive quarterly beats. R&D spending, research and development, surged strongly year-over-year to $18.5 billion, falling to 8.6% of revenue. During earnings Q&A, when pressed on whether growth can outpace hyperscaler capital expenditure, management pivoted emphasis away from primary cloud titans toward a fragmented sovereign AI market. What management claims is broad market diversification. What the lab hears is cloud customer concentration reaching a natural ceiling. Watch R&D as a percentage of revenue in the next filing. If it drops below 8%, growth momentum is stalling. The momentum breakdown for NVIDIA. RSI sits at 59, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. NVIDIA's Moat durability rests on 2 primary engineering pillars. First, the Blackwell platform integrates dual-die compute and high-bandwidth interconnects that custom chiplets cannot easily match. Second, the proprietary CUDA software environment binds developers to NVIDIA silicon across millions of enterprise data center nodes. This software layer insulates hardware pricing power. The primary risk centers on physical packaging yields and custom silicon substitution. Hyperscalers are actively ramping proprietary accelerators to bypass merchant silicon margins. Meanwhile, export restrictions limit Chinese market penetration for compliance hardware. Current daily filings show ARK Invest holds $296 million across multiple active funds. Historical 13F filings show institutional managers like Vanguard increased standing exposure. Here is the question institutional analysts are quietly asking. Can Blackwell gross margins hold above 75% as TSMC packaging costs escalate? The lab's answer is clear. Foundry packaging surcharges and complex multi-die assembly will pressure initial production margins. However, full system rack integrations offset component costs by capturing total data center spend. The lab frames forward durability through 2 operational conditions. If data center revenue growth sustains above 80% alongside stable packaging yields, Blackwell's architectural moat is verified. If custom ASIC deployments erode hyperscaler order backlogs, multiple compression will accelerate across merchant silicon suppliers. Fiscal second quarter data center gross margin is the definitive metric. The lab assigns NVIDIA a Moat durability score of 78 out of 100. Here's the macro picture shaping NVIDIA. Tightening BS export controls limit shipments of compliance-tailored GPUs like the H20 to Chinese hyperscale. Marvell dropped 5.6%, and everyone is panicking. Yet Marvell commands a $212.8 billion market cap, driven by its custom ASICs that power enterprise cloud data centers worldwide. Those chips lock in multi-year contracts, delivering margins that eclipse typical foundry pricing and insulating earnings from cyclical downturns. The Moat score is 64 out of 100, durable. Here's what the business evidence says. What operating evidence matters most for Marvell Technology Incorporated? Marvell's durable Moat centers on custom ASIC, application-specific integrated circuit chips tailored for enterprise cloud infrastructure. And another question, what could weaken Marvell Technology, Inc.'s Moat durability? Meanwhile, an EPS growth rate, earnings per share growth rate, down 80.4% reveals clear operational pressure. Google was granted equity warrants tied to a $120 billion custom chip purchase commitment. Marvell's margins depend entirely on CoWoS packaging yields above a certain threshold. That threshold determines whether the deal works. EPS miss versus consensus shows yields are already pressured. Guidance must address margin sustainability. The hardware bottleneck is silicon yield in custom ASICs, application-specific integrated circuits for enterprise cloud workloads. Marvell's 800G optical interconnect DSPs, Digital signal processors converting light signals to data compete directly with Broadcom's Tomahawk chips, where Broadcom commands over 60% market share. If CoWoS yields drop below a critical level, Marvell's production costs soar, undercutting the profitability of its custom chip contracts. Quarterly financials showing modest revenue momentum for Marvell. The Marvell trade isn't about chip demand. It's about the cost of borrowed money. With the Federal Reserve benchmark rate at 3.63% and the 10-year Treasury yield at 4.69%, elevated borrowing costs create friction for capital-intensive semiconductor build-outs. Yield curve normalization at plus 0.5% reinforces a tighter liquidity environment. When capital's expensive, capital leaves. Kalshire prediction markets place recession risk at low levels, but elevated yields pressure corporate capex. Capital expenditures for long-term technology infrastructure. TSMC's July revenue surge of 44.7% year-over-year confirms real in-market chip demand, yet high interest rates force hyperscalers to scrutinize every design dollar. Geopolitical and policy restrictions continue to construct real physical friction for chip developers. Strict BS, Bureau of Industry and Security, the federal agency enforcing export controls. Rules restrict Marvell from selling high-end interconnect silicon into mainland China, directly capping high-margin foreign shipments. That's where the real money lies. Meanwhile, trade war friction and tariff uncertainties increase cross-border supply chain overhead. On the social front, mounting political scrutiny over massive hyperscaler capital deployment is forcing cloud operators to demand lower hardware costs. Wall Street tracks current quarterly revenue growth of 27.6%, but ignores how macro trade restrictions compress long-term operating margins. If geopolitical export controls expand further, Marvell's total addressable networking market shrinks in real time. Marvell reported earnings per share of $0.80, missing the Wall Street estimate of $0.81 by 0.9%, a miss that raises questions about near-term guidance. Marvell, custom ASIC networking, is trending higher at $237. Marvell delivered record first-quarter fiscal 2027 revenue of $2.418 billion. Matt Murphy, Chairman and CEO, Q1 2027 financial results. Management uses top-line records to distract from earnings execution. Wall Street bid up the stock on multi-billion-dollar warrant headlines with Google. Yet Marvell actually missed non-GAAP EPS at the reported figure versus the consensus estimate. That extends a 0-for-4 beat streak. While management spun future growth, company insiders quietly net sold 56,263 shares over the past 90 days. When executives unload equity during a hyped partnership announcement, investors must look past the press releases. The real divergence appears in the filing fine print. In the latest Form 10-Q, management expanded risk factors to cite customer concentration. While press releases touted custom chip wins, R&D hit the reported R&D spend. That consumed 25.3% of total revenue. What management says is accelerating growth. What the lab hears is rising costs to keep key customers. Watch non-GAAP gross margin. In report, if it drops below a certain threshold, the Moat thesis breaks. The momentum breakdown for Marvell. RSI sits at 65, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Marvell's durable moat centers on custom ASIC, application-specific integrated circuit chips tailored for enterprise cloud infrastructure. Its market leadership in 800G optical DSPs, digital signal processors converting optical light into electronic data, embeds its hardware directly into AI data center architectures, insulating core enterprise revenues from immediate competitor replacement. However, aggressive competition from Broadcom threatens Marvell's market share in high-margin custom silicon design. Meanwhile, an EPS growth rate, earnings per share growth rate, down 80.4% reveals clear operational pressure. Standing 13F institutional position filings reveal notable divergence, as FMR trimmed its stake by 57% while Vanguard expanded its position by 48%. What is the single engineering metric determining whether Marvell's business moat remains intact? The answer is custom ASIC gross margin retention. As hyperscale cloud providers gain immense leverage by demanding equity warrants, financial contracts granting customers rights to purchase company stock, Marvell risks slipping into a lower-margin contract chip designer rather than remaining a high-value proprietary silicon vendor. If gross margins compress below 60%, the structural moat thesis dissolves. Here's the macro picture shaping Marvell. Strict BS export controls restrict Marvell from selling high-end 8. HEICO jumped 1.3%. Moat scores 83 out of 100. High durability. A $49.6 billion market cap underscores the scale of its FAA-approved parts empire, a backbone for defense contracts. At $355.04 per share, investors price in the durable replacement part pipeline and steady aftermarket demand. The lab will dissect how that moat translates into cash flow resilience and future growth. What operating evidence matters most for HEICO Corporation? HEICO holds a structural moat through its FAA-approved replacement aviation parts portfolio. And another question, what could weaken HEICO Corporation's moat durability? FAA, Federal Aviation Administration, the governing agency regulating civil aviation safety, grants approvals that create steep entry barriers. HEICO delivered $1.66 earnings per share, beating estimates by a significant margin. Capital is actively rotating away from high-beta tech into high-margin aerospace infrastructure. Wall Street expects commercial fleet utilization and defense backlog expansion to drive revenue beyond recent quarterly levels heading into earnings. The engineering reality driving HEICO's margin dominance is PMA, parts manufacturer approval, the FAA regulatory certification for replacement jet parts. HEICO casts turbine components engineered to survive 1,600 degrees Celsius. By maintaining precision tolerances within 0.0001 inches, 1/10,000th of an inch, HEICO replicates OEM hardware reliability. OEM parts cost significantly more than HEICO alternatives. Here's the margin. When hardware defect rates remain near zero, replacement demand converts straight into expanding operating cash flow. Quarterly financials showing modest revenue momentum for HEICO. Marvell's down 5.6%, HEICO's up 1.3%. The divergence reveals a strategic capital rotation. Institutional funds are actively fleeing cyclical tech risk for defense plays shielded from consumer softness. Rates sit at heightened levels, the 10-year Treasury also higher. These rising borrowing costs crush semiconductor margins. Higher rates force airlines to extend aircraft lifespan instead of replacing them, driving replacement part demand. Simultaneously, geopolitical pressure is accelerating defense budget expansion. Recession risk stays low at plus 0.50% yield spreads. The macro setup delivers a dual advantage. Rates compress tech margins while extending aircraft life, and defense mandates guarantee HEICO demand. Trade frictions with Canada are exposing structural supply chain risks for aerospace metals like titanium. Yet ongoing conflict across Europe and the Middle East is forcing global defense budget expansion under U.S. Defense Authorization Acts. These geopolitical constraints insulate HEICO from consumer softness, driving 25.3% revenue growth. Earnings amplify the strength, 48.2% EPS growth. High borrowing costs squeeze capital-intensive tech margins, but government defense mandates provide an unyielding cash flow floor. Mandatory defense maintenance schedules guarantee demand that high rates cannot dismantle. HEICO reported earnings per share of $1.66, beating the Wall Street estimate of $1.35 by 23.3%. A solid beat that signals strong execution. HEICO is trading below its 20-day average, currently at 355. Management's headline for Q2 fiscal 2026 led with record net income, up 49%, on record operating income, up 41%, and record net sales. In fact, executive PR crammed the word record 19 times into a single release. That linguistic barrage is designed to make you fixate on top-line momentum rather than long-term margin limits. But while executive press releases screamed perfection after delivering a 23.3% EPS earnings per share, the portion of company profit allocated to each share of stock beat at $1.66. Corporate insiders quietly net sold 1,326 shares over the past 90 days. When management floods press releases with superlatives while selling personal holdings, executives are taking profit at peak expectations. Looking at standing institutional positioning from 13F filings, quarterly equity holding reports filed by institutional managers, institutional conviction is splitting. While UBS Group AG expanded its stake by 52%, Capital World investors trimmed 29%, and New Perspective Fund cut 30%. In the 10Q filing, quarterly financial report required by the SEC, management relies on acquisition growth to drive top-line numbers while offering only generic forward guidance. What management is saying is record-breaking operational triumph. What the lab hears is acquisition-driven growth hiding organic stabilization. Watch for consolidated operating margin, operating profit divided by net sales, to hold at 25.5% in the next filing. If margins contract, the compounder thesis cracks. The momentum breakdown for HEICO, RSI sits at 45, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. HEICO holds a structural moat through its FAA-approved replacement aviation parts portfolio. FAA, Federal Aviation Administration, the governing agency regulating civil aviation safety, grants approvals that create steep entry barriers. By offering certified jet components at lower prices than original suppliers, HEICO captures high-margin aftermarket demand. Rising global military budgets provide a multi-year growth runway independent of economic cycles. However, valuation leaves zero margin for error at a trailing P/E, price-to-earnings ratio comparing share price to net profits, of 63.3x. 13F filings reveal slow-standing positioning trims, with Capital World investors reducing holdings by 29%. Here is the core question institutional analysts are asking ahead of Tuesday's earnings report. Can HEICO maintain its 20% organic growth pace as Boeing and Airbus increase new jet deliveries? The lab's analysis indicates yes. New delivery backlogs mean airlines must run legacy aircraft longer, accelerating wear cycles on engine hardware. As long as replacement part approval velocity remains steady, HEICO will capture lucrative maintenance cycles before new fleets mature. If Q3 organic revenue growth stays above 15%, it proves replacement pricing power remains intact despite material inflation. If growth decelerates below 10%, it signals OEM price cuts are squeezing HEICO out of key engine platforms. HEICO is the lab's priority watch, with $377 testing thesis durability. Here's the macro picture shaping HEICO. Rising military budgets under the U.S. Defense Authorization Act and global conflicts in Ukraine and the Middle East directly fuel orders for NVDA's durability score of 78 is the loudest signal we've seen all week. That number doesn't lie. It's built on die yields, CoWAS lead times, and Blackwell's Fort NP ramp. What did the data miss about NVDA's competitive position? Tell us below. This isn't financial advice, just the lab's take. Markets move fast. Past performance never guarantees future results, and you should always run your own numbers. We're here to teach, not to trade. Hit subscribe for the next deep dive. We'll show you the exact wafer starts behind the numbers. If you want our full breakdown on AMD, the link is in the description. Stay sharp, engineers.